Hey guys, it's Maureen here, and wow, what a whirlwind of a week in the crypto world, huh? With the Bitcoin ETF finally getting the thumbs up and Bitcoin itself hovering around $40,000 USD, of course. It's been non-stop. Plus, all of those new rules shaking things up. But today, we're shifting gears a bit. We've got Dell with us. Yeah, Harry from TikTok. You may have seen him, you may have heard from him, but today you're in for a treat. He's here to help us make sense of all those tricky tax questions we've been wondering about. Ready to dive in? Harry, great to have you. Let's get the conversation started. Hey, welcome to Web3 Weekly with your host, Blockstar Technology.
Let's go. Hi everyone, we're here for episode 63 of Web3 Weekly with Blockstars, and we've got our special guest, second time round, Harry Dell. Harry, could you do an introduction of yourself and what you do for anyone who hasn't seen our previous podcast?
Yeah, sure. Thanks for having me on, both you guys. So I'm a crypto tax lawyer, and there aren't many of those around. We do advisory services for crypto projects, investors, anything that involves crypto, and also, more traditional businesses as well, but who cares about that? And I run a firm based in Brisbane and Sydney called Cadena Legal, where we do tax law and we also do commercial. So we see the pretty pointy stuff.
I'm sure you'd come a lot of interesting projects in your line of work, Harry. Yeah. For anyone out there, if we start from the basics of understanding crypto taxation, for anyone out there that is purchasing crypto, trading crypto daily, buying mem coins, selling mem coins, what are some pointers and some understandings that they should know before getting into it?
What everyone should understand is there's no separate set of rules. You're in the same set of rules that govern whether you're trading in real estate, shares, futures, whatever. Crypto is falling into the same rules. There's no specific exemptions, nothing like that. So we've got to be thinking about capital gains tax and when we're going to trigger it. However, because those rules are so general, it doesn't always fit in a way you would expect. So you may have some inappropriate taxing points, and tax should never be front of mind. The first thing you should be doing is making money. And the second thing you should do is making sure that it's in a tax effective way. But if you are dealing in a significant amount of crypto, make sure that you understand where those taxing points are before you do it. And there may be things like bridging, wrapping. If you're getting a loan, it may still be taxable, but also it's not definitely taxable. So there is gray area to work in. But if you're a person who's worried about their tax compliance, as many people are, then the conservative approach is to just accept what the ATO is saying, understand those taxing points, and put the money aside to cover it. That's the bit that people forget.
Yeah. So, Harry, just on that point, you mentioned that the same tax rules apply to real estate, stocks, share, everything like that, which is capital gains. So why would ourselves in the crypto community be angrier about it? I feel like there's more of an uproar that it applies to crypto. Do you find that, or is it just me?
There is still this belief that crypto is not subject to tax in Australia. People have weird justifications for that. One of them is, it's not regulated by the government, therefore why it's taxable. Doesn't matter. You could be trading in unregulated onion futures. It's still going to create taxing points if you're creating money. That the tax law is created to capture your income or capital gain. It doesn't matter what you're doing to accumulate it. Even illegal activities are taxable.
Yes.
People forget that. There's been a few cases of, heroin dealers who get caught and then, they get away with it, but then the taxman slaps them because you can see how much money they're making pretty easily.
Yeah.
When they're buying Lambos, like the crypto boys.
Yeah.
There is that perception, first of all, but even beyond that, I said before that they're inappropriate taxing points. So you can't deal with many assets like you can deal with crypto assets.
Yeah.
You can't wrap a BHP share and stake it somewhere and get extra yield, and then stake whatever coins you got from that and restake it somewhere else. Like, you can't do that. So this asset class just gives you a lot more options to do things. And those things would have always triggered tax consequences, but we just never thought of it before because it was make-believe. But now you've got more access to do what you want with your capital and your money and your investments. It just throws up all these weird issues.
Yeah.
Yeah.
So
and
sorry.
no, you go, Harry.
No, I forgot what I was going to say, so you have to go now.
All right. I was going to say, as you mentioned with like staking, for instance, and also wrapping of tokens, which was an interesting one, but which we'll come back to. But how does the taxation work on if you're staking and you're earning a decent income from that? Well, you're getting paid out a decent amount of US dollar value tokens. What happens with that? Like, say I get 100 tokens today, and I go to sell them this afternoon, and I got them as a reward from a liquidity pool, for instance.
Let's start all the way at the start. I assume this isn't advice for you, mate. You'd never do anything.
I was just about to say that. It sounds like someone's been staking Ronin.
No,
someone's been staking. Oh, it's all for Maureen. Yeah, of course. Well, starting all the way at the start, like, let's just start with a really basic example. I like to use PancakeSwap.
Yep.
So when you were doing auto cake, you would stake your cake tokens, and this is the ATO view we're going to start with, and we'll attack it later. Yeah. So the ATO view is that's a CGT event. So if you bought it for 100, it's worth 200, then you stake it. You've had a capital gain based on that $200 value. Mm-hmm. Then you've staked it. You've got an income stream. You actually get cake every like 5 or 6 seconds. It was crazy. Just kept going. Each token that you acquire has an acquisition time. Well, first of all, it's income. Income comes in, gets an acquisition value at whatever it was worth then, and a time. When you sell them, the accepted view of what you can do is you can say, well, I sold the ones I earned 2 years ago and claim that 50% CGT discount. That's what people do. But the ruling that enables that to happen is actually only in relation to shares, because you can buy shares. Obviously, they're all the same. They're fungible, effectively. And you can go, well, if I can identify it's those ones, then that's how we'll treat it for tax purposes. We do the same thing with crypto, even though there's no ruling to that effect yet. It's a minor issue. So picking which ones you're selling, like if you acquired them that day and then you sold them that day, there's probably very little capital gain or loss. But here's where the problem comes in for staking is I've earned income. Say the cake is trading at $1, and then cake gets rugged and then it's trading at 1 cent. I've just earned $1 of income and I sell it to realize my 1 cent because that's all I've got. I then have a 99-cent capital loss. You actually can't offset it too. So you're still stuck paying, whatever your marginal tax rate is, or if you're a company, your corporate tax rate on that $1 that you earned, but you don't have $1 anymore. And this is where it like really attacks retail investors into these staking products. Retail users, they're not investors, are they?
Yeah. So you're saying that, hold on, let me get this straight, Harry. I'm wait.
I've upset you. I understand.
Do you have? Because I was under the impression that the same way we could roll over capital gain, you can roll over capital loss. So if I have lost, say, 2,000 monkey balls or something like that cost me a lot of money.
Long story, Harry. Long story.
It is a long story. I could tell it quickly, but we won't. If I lost a bunch of monkey balls and a bunch of money on that, and that is a loss, if I make some money on Ronin next week through staking, I can't. You're kidding.
Well, you've got two kinds of losses here. Sorry, gains and losses. You've got revenue losses, which are income, and you've got capital losses that are capital.
Okay.
You can't apply capital losses to reduce income. And if you're earning stuff, if I'm earning in BHP shares or Bitcoin or whatever, and then it rugs and it drops, I've got that capital loss. I can't offset that against the income that I get. So this affected people with like staking products primarily. It also affected a lot of people who were paid in Bitcoin. And I don't like paying people in Bitcoin. It's like paying people in bananas. Like they can go up and down. When I get paid in something, I want to get paid in something stable. That's for another time. But people who are making income in an asset with economic risk, and then that risk is a downside risk, they have a bad outcome, very bad outcome. So bad that I've seen people go bankrupt because they made $3, $4, $5, $6 million in the bull run, doing yield farming, doing all sorts of nonsense. And obviously those mostly blew up in 2022. That was the bad year. I'm trying to forget it. But like people had a really bad time. And it was the final nail in the coffin was they got a tax bill for $1-2 million. And they actually had less than $1 million in the bank. Like, what do you do?
Yeah, that is ridiculous.
Yeah.
So what do you do, Harry?
You go bankrupt. But what you should have done is keep those stables aside. But even that's not always safe because I had a lot of people store it in Anchor protocol. And that didn't end up very well, did it? Because they go, well, if I'm going to put money aside for tax, I'm going to go stake it somewhere. And I'd stake it on Anchor and get 19%, which was clearly unsustainable in hindsight, definitely so. The most conservative thing to do is put aside whatever you think your tax bill is going to be as a percentage. If you think you're going to pay about 30% tax, put aside a third of all your gains. And if you start making some losses, you can maybe reduce that account, but actually separating that money and not having it at risk, because any staking contracts, it's a risk. And you guys build these staking contracts, not every contract's going to be perfect. There's always new vulnerabilities. Some of them are human error, whatever. If you've got your crypto stored in any of those, like, it's not safe.
Yeah.
Yeah. And on that, so how would they look at it? I've sort of got two questions there, but just on that one, Harry, you touched base on. If I had $1,000 of, say, Ethereum in a staking contract, and then I'd been earning some kickbacks of tokens, all within this platform, for instance.
Yeah.
And then say FTX, for instance, prime example, FTX, it was super easy staking on there. They paid out pretty well. And then suddenly the whole exchange goes and runs off with your money, or it goes busts or gets hacked. What happens on the tax implementations on that? Because I've now lost my initial asset.
Yeah.
And then the assets I've been earning, as we've been talking about, as it's say an income, now that's gone as well. How does that process look?
Mate, it is insanely complicated. How crazy a question that is. Let me take you through it with shares, okay? Shares is really straightforward, and then we'll do crypto next. So shares, shares in a company. Company goes into administration, goes into insolvency, and it gets liquidated. I can't claim a capital loss on the shares that I purchased until the liquidator says those shares are worthless. So that you're waiting for that declaration. And there's this very special CGT event for that. I think it's CGT event G3 or something. But that's specifically for shares. The liquidator says you get nothing. And that's what, bang, capital loss. You got nothing. You put in $1,000, you get a $1,000 loss. That's the trigger point. With crypto, you don't own shares in the company, of course. But on an exchange, you don't own the crypto either. You are just an unsecured creditor, which is why FTX going through these bankruptcy proceedings in the US is revealing this interesting issue in that if I have one Bitcoin in FTX, I don't owe one Bitcoin. FTX owes me the spot price of one Bitcoin. And they can choose to pay it out as a Bitcoin withdrawal, as a unit in my bank account, as any other token that I want to swap it to in any network. But all I've got is a debt. I'm owed money. I'm owed value. It's an IOU. And then when FTX goes into administration, you as an investor, it doesn't appear like you can claim a capital loss until your debt is written off. Because you've still got a debt, you're waiting for the administrator to pay it back. FTX is a really funny example because when FTX went insolvent, compared to now, asset prices have increased. So a lot of people are actually supposed to get more, like 100% of their initial investment back. But obviously, Bitcoin price was changing. I think it was 11 November, around that, early November 2022. Insolvency happens, your value is locked from that point. Say it was 10,000. Bitcoin goes up to be worth 40,000. You still only get 10,000 back because you didn't actually have one Bitcoin. You had a debt, and at that date it was locked as like, we can't afford to repay our debts. And then you eventually get repaid. And this gives a really weird situation where you may have realized income from staking, which you need to report as income. It's just being paid into your FTX account, capital gains and losses, whatever. But then when this company goes into insolvency, bankruptcy, administration, whatever, you're just a creditor. You just have a debt owed to you. The conservative view is you can't claim the loss yet, which kind of is stupid. You would think, like practically you would think, you claim the loss now, and then if you get something later, you would declare a capital gain.
Yeah.
But it's not quite that clear. And there's a client that we're working with currently in Australia related to FTX, not one of the FTX entities, where we're obtaining a class ruling related to insolvency and crypto. And this should make it a bit clearer. And it's been a really interesting process. We're working with the ATO very closely on this. We didn't go in there with like a loaded message of like, we want to claim these losses up front. It was just like, we actually just don't know when we can claim losses, like what are the trigger events for stuff. ATO has been really engaging actually, where we just said like, here's all the possible answers. Just pick one. We don't care. And that's been really helpful for FCX creditors and a whole bunch of others going forward. And I look forward to when that ruling is coming out. Hopefully, maybe Q2 this year. Guidance on specific products for the next phase of ATO guide. I'll probably segue into some later questions for you. The short of it is the insolvency stuff just doesn't work very well. But say you lost money on Bitcoin and you're earning money somewhere else, you still pay tax. You haven't crystallized that loss yet.
Yeah.
It doesn't feel right.
Well, it's funny that you say that because the way that you explain it and its simplicity is number one, really great for people like us because we can actually understand. Sorry for saying like us. I meant people like Charlie, so we can actually understand. I'm just joking. That's really great. I have another question out of the air. It's got nothing to do with me. Say hypothetically, someone, because you brought in, insolvency of companies. The other really difficult thing I'm sure you would find is that a lot of these companies, because crypto is borderless and it's cross jurisdiction, and a lot of companies that, even retail investors might purchase crypto are actually located abroad. What happens when, you take that scenario, but what if you add another level of complexity where you had a company internationally that you went and bought all this crypto from, and then they went bankrupt or insolvent? Like, what are the tax implications? Like, where would people sit? How do you prove that? Do you still have even just a debt that at some stage you can roll off? What are your legal rights?
It's just a debt in almost every single case. I assume you're involved in Mt. Gox or something, Maureen.
I don't want to talk about it.
Oh, right.
And I'm joking. No, I wasn't. But Hotbit, if you've heard of them.
Oh, no. Yeah, not heard of that one. There was quite a few sort of in Southeast Asia.
Yeah.
Most of them were situated in relatively good jurisdictions. Mt. Gox was Japanese, I think.
Yeah.
And it's just the insolvency cogs turning. That's what you got to wait for, because in almost every case you just you owed money, you're a creditor, that's it.
Yeah.
But I think like Mt. Gox, they were actually made whole, 7 years later or something, or 5 years later.
Yeah, I think that was sort of like a good outcome for them. But
are they still waiting the Mt. Gox?
No, I think
it's still going, but like a lot of people got paid out.
Yeah.
It's just these things take years. Liquidators got to get their pound of flesh, and that's
so. What's really sad is from this conversation, I think one thing we can probably take for certainty that there's only two sure things in life, and that's death and taxes.
That is a famous saying.
And now speaking to Harry, I think we can see why.
Death isn't always certain, but taxes are always certain.
or even when you're doing something illegal, he's telling us.
No,
Right.
I've seen the memes about that one too. Yeah. But we're back to the staking, Harry, where you said, like, say I earn $100 this week in a staking pool, or let's just say I earn $100 today for staking, and then I go and swap that token that I've earned into a stable coin, for instance. Is that, from what I gave it before, that is no capital gains tax, but that would come on income tax?
Well, the staking income is the income.
Yeah.
So say you earned, $5 worth of Ether, and then Ether goes up to $6, and then you swap it for USDT. You've had a $1 capital gain there. Yeah. But because you haven't held it more than 12 months, it basically just gets added to your income anyway. So effectively, it's taxed as income. Does that answer your question? You got to think about all of these different taxing points. It's not just the one you've earned it and then do what you want. It's like you've earned it, you've swapped it, you've staked it, you've transferred it to an exchange, which I believe is a taxing point as well.
Yeah.
Annoyingly enough, but under the current rules, it seems to be the case. All of these things, like, how are those taxing points? And it's just these little gains and losses, like annoying amounts. And then there's things like gas on top of that. Like, where does the gas go? Because the gas, like Ether is gas, you bought it for, X, and it's gone up, and then you're spending it as gas. You can actually have a capital gain on your gas expenditure as well.
Wow. So, I mean, Harry, like, you've given us so many great examples. Some we sort of knew about already or have come to terms with. But based on what I just had to choose my words carefully. But based on what you're saying, like, you being the tax professional and the absolute expert in this field, what would your suggestion to the ATO be to make this, number one, an innovative product that we could keep people in Australia, but number two, just something that's still viable for us to even, deal with?
To be fair.
No, we don't need fair in tax. We know that's not going to happen.
It's got to be fair compared to other assets.
Yeah.
So right now we've got a situation where the tax burden and compliance on crypto is much higher than, say, shares or real property.
Yeah.
It's just really frustrating, and we need to have these tools like crypto tax calculator to reconcile that data. But that's just one step. It's like using Xero, but not actually reconciling all your bookkeeping. We still need to go, well, okay, is this income? Mate, I don't know. We're using our best guess based on our knowledge of tax. And we know lots of things probably are income. Some things are not. Not all staking income is income. Not all swaps are CGT events. Some tokens are a bit different. And one example that I like to give people of some tokens that are different, you've got Bitcoin, which is a utility token, effectively, native token on Bitcoin network. You can use it as gas to send Bitcoin around. That's basically it. But USDC on, say, the Ethereum blockchain, it's actually more like a convertible note. I can convert that back into USD. So, like, they're very different tokens, and they should be treated a little bit differently.
Yeah.
If I just own USD, I'm under the foreign exchange rules. But if I own USDT, I'm in CGT again. And it's like, well, that's a bit weird. We don't need a lot of adjustment, but we need clarification about when is income derived. Like when do I pay tax on it? If I'm staking in a smart contract and I don't press the claim button, when do I pay tax? Is it when it comes in my wallet? Because I can track that data really easily. CTC will just pick it up, that's fine. But if it's unclaimed rewards in a smart contract, how the hell do I know what the value of cake is every 5 seconds? It's just not feasible.
Yeah.
I've made some suggestions to the ATO. We went through a consultation process recently to get some guidance out there. We did get some guidance. I wasn't very happy with it. That's pretty well known. But we've also got the Board of Tax report, and the Board of Tax is an independent body, which I've made extensive submissions to. So I have a lot of my colleagues in this field, where it's like we're not after lower tax burden than any other asset class. It's just really about compliance. I've seen people spend $5,000 or $6,000 on getting their tax report correct. You know, the big traders. It's just crazy. It shouldn't be that hard. When stuff income, are these capital gains tax triggers or not? Can I account for it in, you know, can I say, well, I sold some Bitcoin, but because it's all fungible, how can I pick which Bitcoin that it was? I can't separate the blue and the red water. It's all purple.
Yeah.
So if I can go, it's that one, and then I'm confident that my tax report is correct, that's actually going to help the ATO, because they're the ones that are going to have to pick up these reports and find issues. And I tell you, every issue that they would find, I could throw back at them and say, well, it's arguable either way. Like, if you want to run that argument, that's fine. I want to run an alternate argument. And we just need a little bit of clarity about this is what's okay. And frankly, ATO website is not good enough. It's got to be in a binding public ruling so that I can point to it and say, yes, we can use the first in, first out method, unless we account for it this way, and then we can use the, you know, lowest tax first out method or select the parcel like we do with other assets. And also, how do we value these assets? And what if we're right? How do I trigger CGT when my assets go all the way to zero?
Yeah.
Right now, I tell people, like, just transfer it to the burn address or transfer it to your spouse or transfer it to a friend to trigger that CGT, so you can go as well nothing, so you can actually claim the loss. This is all just like nonsense.
Yeah.
So it's just like, let's remove the nonsense. Let's just get some very basic rules in place, and I'll get happier. Because this is the retail side. Wait until we get to the business side. Tokens and running liquidity pools, like that's a whole nother nightmare, 10 times as bad. The retail stuff shouldn't be this hard.
Yeah. So, I mean, I guess you are probably speaking from the perspective here in Australia. How are we going in the international front? Like, are there other countries that are getting it right, or has everyone made a mess of it equally? Or
it's all inconsistent. Like, I can say to the ATL, like, look at you know, the UK HMRC, and look at what they're doing. Like, they're doing some good stuff.
Yeah.
But you talk to the UK tax accountants and the tax lawyers there that do this stuff, and they go, yeah, like, it's better than nothing, but also it's wrong in other ways as well. Yeah. Like, it's too general, and they've said, you know, staking is income. It's like, well, yeah, sometimes, most of the time even, but there's cases where it's not. And what we sort of want is just like, well, if it's like this, it's income. But if it doesn't have those features, you know, you should get some professional help. That's fine. But what we're seeing tax authorities come out with, like, this is what it is. So some of them, for instance, the ATOs is a really good example. ATO says, hey, Bitcoin is property. There's a ruling out there that says that. If a lawyer reads that ruling and they start a whole bunch of cases, the argument's very weak. And we, you know, our senior associate here at Kadena, he's running a private ruling, and we'll eventually run this case that Bitcoin is not property, from the point of view of, if it's not property, it's actually not subject to CGT at all.
Yeah.
The laws need to be fixed. ATO is not really interested in engaging in that process at the moment. Pretty big issue. Is it legal property? It has issues beyond tax and insolvency and family law and all sorts of things. Like, it has value, but is it legal property? UK Law Commission says it's not property. And we need to actually put in a new definition of property to capture these assets. But the ATO says it is property. So someone's got to be right, someone's got to be wrong. And, like, we're just not doing the work to get to that outcome. Like, ATO should be very keen to run a test case. We've got a nice little bowed up case that, like, let's run this case in the courts, get a bit of decisions from the court, and we'll have some answers. But they don't want to do that. They want to just go, well, we make the rules. And it's quite disappointing in some ways, but that's okay. It's an adversarial system. That's what we have to do.
Yeah. And on that one, I'd probably say, with my limited knowledge and understanding, is Dubai.
Yeah.
Dubai taxation on Bitcoin. You don't have to pay any, but, you know, we're not going to get that. We won't be getting that ever, probably. But an interesting one, Ari, was I seen you had a post. I love following your LinkedIn, mate.
Oh, thanks.
About Well, first of all, I remember you talking about wrap tokens being taxable events because it's now no longer the same token you've got, whether you've got Bitcoin to wrap Bitcoin or Ethereum to wrapped Ethereum. And I believe the ATO thinks that's actually a different, because you're swapping that token, even though it's the same but on maybe a different network. Like, you're still getting another token.
Yeah, like that's the ATO's view, is that it's a new token, and like Bitcoin to wrap Bitcoin on the Ethereum network is a really good example. Because like when you have one Bitcoin, it's pretty clear what you've got. You've got one Bitcoin. That's it in your wallet, no problem. When I then put it into the bridge contract thing and spits out a wrapped Bitcoin on the Ethereum network, and I can then do Ethereum things with it. Yeah, I've got different rights. I can do different stuff with it. I can't put Bitcoin directly into liquidity pools, I don't believe. Yeah. Tell me if I'm wrong. So the ATO says, well, on that basis, you've got new rights. It's a different asset. But realistically, all that's happened is my economic entitlement is still to one Bitcoin. There was Bitcoin locked in a bridging contract somewhere that I can redeem and get it out again. And the argument that I've run before is that it's a bare trust, where a bare trust being that someone holds it on my behalf, and when I want it back, I just have to call for it, and they have no other things to do. It's basically at that. The trouble is, it's essentially automated. It's not a person. It's a smart contract with the keys are burned, so no one can just rug it, hopefully. So like these traditional legal arguments that we would run don't really work in this technology very well. Like if you're on the deed for my house and we had a bare trust deed saying, Charlie, you own this property on bare trust for me, the ATO considers that I still own it. And if I then transferred it to you, you transferred it to me, then there's actually no CGT event there. Nothing's, it was always mine. It's just now in my name. But we don't do that. And I think the ATO is taking a very rudimentary view of these contracts. And these broad strokes, you lose so much of the nuance. Because really, I still have a Bitcoin. It's not a good taxing event.
So, Harry, like you've mentioned that the people that are calling the shots in the ATO, I'm just wondering, what sort of level of technical knowledge do you really need to have in order for you to make these decisions that are affecting so many people? Like, clearly you need an in-depth technical knowledge. You need to understand how things work, what the cause and effect is. Do you think that the right people are in the office to actually be making these determinations? And that's not meant to sound political. I'm saying, obviously, we're using technology. It's a mix of technical knowledge as well as law, as well as tax knowledge. Like, what are your thoughts on that?
The people that are making these decisions are relatively senior, both in the policy area of the ATO, where they assist with the advice and guidance. There's also an area called the Tax Council Network. I worked in Tax Council Network for a little while. Damien, who works with me now from the ATO, was there for a very long time. He was in a different advice and guidance area and other areas. But it's not, the power users of crypto in the ATO that are making these decisions. It's the people with that tax technical knowledge, that legal knowledge, and they're trying to understand how this asset works. And the trouble is, it doesn't work like many other assets do. Like I've had requests from the ATO. They go, list all the holders. I'm like, well, I can't really do that. And also, if you wanted all the wallets, just here's a link to Etherscan. Go for it. They're not understanding, and that's why we're getting into these complexities. And I've said to them many occasions, I'm more than happy to help, more than happy to teach, more happy to do whatever it is that needs to happen, because lacking that capability in the ATO is actually really bad for the industry.
So it is lack of knowledge then, really?
I think it's lack of knowledge of the technology.
Yeah.
And I've said this to, every tax lawyer that's ever worked for me in crypto stuff, is you need to make a MetaMask wallet or a Rainbow wallet, and you've got to do some stuff. That's the only way you're really going to know how it works. When you talk about it theoretically, you're like, here's what a Bitcoin is. It's unspent transaction output. It's like, what the hell does that mean? until you start accepting, you don't really understand what, signing a smart contract really means. You're spending gas, you're like, oh, I'm going to go get some more ether. Like, where's it all going? You can't really put it all together. You need more than just a tax technical understanding. You need that other side of, like, do they use the technology?
Yeah.
I don't think the
discrete. How long have you been in this space? Not the tax law space. Like, how long have you been involved with crypto behind the scenes, playing around, digging deep into the tech? Like, you're very knowledgeable.
So I created Bitcoin in 2009. No. So I remember, like, I was an observer for quite a long time. I actually remember the guy buying the pizzas, and I'm like, this is stupid. The guy buying the pizzas with the 200,000 Bitcoin, like, whatever, mate. I did some stuff at uni in 2015, and I was like, oh yeah, this is interesting. If I wanted to, buy some drugs on the Silk Road, sounds good. But I wasn't really interested at the time. I was too busy. And in a professional capacity, I was actually looking at it when I was in Tax Council Network. We were answering some queries in the ATO around Bitcoin and capital gains tax. This is 2017. This is like 2-3 bull runs ago now, where well before DeFi was really going. And it was just really basic questions. Like, is it an asset? And we're like, oh yeah, it is, because we said it is. And that didn't have that many dire consequences as it did now. It's really, DeFi has taken about 10 levels of complexity.
Yeah.
Also all these problems. Because if we're just dealing in Bitcoin, like, it's actually not that hard. Because when we're dealing in 100 different assets and doing all sorts of weird things with them, that causes the problems. So it's 2017, and did some bits and pieces. It's been about the last 4 years that I've been very deep. The last 3 years I've been relatively prominent, relatively public about it. So that's a long time, I think.
Yeah. And I'll just...
And crypto insurers, mate.
Yeah.
The other thing is, I just want to know, and then I'll let Charlie have a turn of asking you questions. I'm sure he's got so many.
We'll let him.
Sorry?
Don't worry.
Oh, okay. I'm just wondering, where do you get your knowledge from? Like, is there like a source that you go to? Do you follow certain people? Like, where are you getting your stuff from? Like, if anyone wanted to be the next up and coming Harry, what would what would they do? Where would they look? What would they read?
Like, to start, you've got to read the basic stuff, Bitcoin white paper, even the Ether white paper. But in terms of like current stuff that's happening, it's primarily from my clients. Someone's like, hey, this coin's stupid, and it's called .with hat. And I'm like, yeah, that's stupid. And other times it's more complex stuff, like it's deep in things, and it's restaking, eigenlayers coming up. Like, I don't have to go and look stuff up. I don't read news sources. It's actually being so like tapped into what everyone's doing that I just see it, and I'm like, what's this restaking stuff? And I'm trying to get my head around it still. It's like I've staked it, I can stake it again. So I'm like, cool.
One more question. Sorry, and then sorry, I promise that'll be it from me.
Morning.
No, I'm fine, Charlie. No, you're right. Go on.
No, go. I was joking.
All right. So the other big problem is we have on one side an issue with the ATO bringing in tax laws and legislation, but the other side, we would say, would you say equally as bad, is that accountants that are putting these, like, what do you call, tax returns and everything through, they also lack a lot of knowledge as well. So are we, like, what would you consider worse? Like, I find that when I went a couple of years ago to do my tax return before I made a mess of my crypto, I really struggled to find accountants with any knowledge to deal with crypto. A lot of them were still... So where should people really go? Is it fair if it is something that is so acceptable, so required, we legally have to do a tax return, yet we don't have professionals with the right knowledge? Why should people suffer when they are given a legal obligation if we're also not equally given the same legal access to professional people to complete that?
Yeah, and saying that, but before you answer, Harry, is I know what you mean because I've had a family accountant for years.
Yeah.
He's a great guy. He's always done good for me. But I've given him my crypto tax calculator report, for instance, and sent him for all the fines of my report and said, here you go, mate, these are my crypto spendings. And he goes, what's this? Like, no, I need each one of your trades. And I'm like, no, this is the report. Here's the website. You can have a read, and this is what it does. That comes from all
but
my
is that fair that we should have to do a tax return with our crypto, but we don't have anyone? Like, should there not be a level of knowledge they should be brought? He did, but that's fine. But should they not have a level of knowledge that they need to be brought up to adequately provide that service if it's a legal requirement?
There should be those resources and trainings available to these tax agents to do that. Trouble is, the professional associations haven't been providing enough of it. Some of them are starting to. So, for instance, the IPA, which is one of the accounting bodies, they do a crypto day, and I've been to the last two out of two of them, and we've done. I think I did 2 or 3 presentations and some of them. There's not a very deep pool of people who are capable enough to present at these. Some of them are accountants, some are lawyers, some are service providers, some are exchanges, whatever. We're only starting to see those events come through now. There's a few other sort of conferences, and they add on some crypto stuff. And it's very easy for me to whinge and say how hard it is, but I'm trying to give people some basis to start doing it, because what you can't do, and I think this is what some accountants are doing, is they say, Charlie, go do your tax report on CTC, come back, and they just put the numbers in. They don't know what they're submitting is correct. Yeah, it's really risky for the accountant to do that, because they have obligations that they believe everything's true and correct. If they can't even understand your report, they're going to have a problem. And it's created this little micro industry of crypto tax accountants, and they're cashing in because, you guys are a crypto business. I expect that your accountant has some familiarity with the crypto transactions you do. And you can't just go to a regular accountant down the road. You should have someone that can help you with that, and how to get paid in crypto, all those sorts of things. And all those accountants that don't have those skills are losing out, and all the accountants with those skills are gaining those crypto clients, plus all of those associated businesses. They're growing very quickly. It should be a supply demand question.
But okay, all right, great. Hypothetically though, we have a situation where, say, for example, you go to a professional in an industry, you lack the knowledge, hence you engage a professional to do a job. So where does the ATO sit? Are we as retail investors or people, everyday people, responsible for an accountant's learning? What if we were to go and do our tax return with an accountant and say, because they didn't know what they were doing, it was early days, they did it wrong and we suffered? Aren't there years, isn't there a law of 3 years, you can't go back? Why should people suffer at the lack of knowledge because of an obligation that has been put on legally without the proper resources of that professional knowledge? Does that make sense?
Yeah, it does. The obligation. Yeah, I can tell. The obligation's on you to lodge a tax return. That's and you have to come up with the figures that go into it. This is the self-assessment system we've had since the 80s. We don't have the ATO assessing it anymore. You have to do it yourself. There's nothing in there that says you have to get a professional to do it. Getting a professional is optional. But finding someone, most people use tax agents still, even though we've got MyGov online, you can lodge it yourself in, not long at all. If you've got anything complex, almost everybody will go to a tax agent because you expect that they have that knowledge. And for 99% of things that they will, but not every tax agent can know everything.
Yeah.
Just like not every tax lawyer will know everything. I declined some jobs because I'm just look, that's just not what I'm good at. You would be paying me too much money to learn, or I would be, writing off all this time. It's just not a good use of anybody's time and resources. So specialist tax agents have always been a thing. And it's kind of just another facet of that. What I will criticize though is the ATO has not done a very good job at marketing their changes and what they think. They just like update the website, and it's not really good enough. Which is why a ruling would be very helpful, a public ruling on accounting stuff or whatever, how to account for a retail user. So we have a bit of protection, and you can say to you like, and then the tax agent can go, I have a piece of stuff from the ATO saying, here's how I do X. And they could go and learn the software tools, which with a bit of practice aren't that hard to do. But what we really got is users like yourselves who need tax assistance, tax professionals who aren't really interested in learning about this space because tax agents have more than enough work anyway, so they don't really have to go out and chase that many clients. But number two, just the perception of crypto as an industry. They don't like it. They go, oh yeah, what are you doing? Buying drugs in the Silk Road? You're like, mate, it's not 2012 anymore. But that's still what they think. It's just very ingrained.
Yeah.
So they are not meeting that demand. That's what we're missing. Should the ATO be doing a better job? Yeah, ATO should be doing a better job by saying this is like a quarter of Australians have crypto. Tax agents need to be aware of it, and they're not. And the professional association should be adding on that training. The ATO should be saying, here's stuff you need to be watching out for. You know, they have alerts saying, you know, try and lodge a tax return that says, oh, this client has crypto. Have you checked that? Like last year, they were freaking out. Tax agents were like, you've got crypto? And they're like, yeah, they're crypto for ages. Never asked about it. And they're like, oh, like it's only really getting picked up now. The tax agents are very slow. There are, 5 or 10 sort of firms that are really ahead of their time and are grabbing all those clients, and they've got like shitloads of money.
Yeah.
Swear on this.
You're allowed.
Okay, so I'll keep that in mind. But they're making so much money because they can just attract all these clients.
Yeah.
And the Web2 entrepreneurs that we used to see in 2005, 2010, that was coming through. We got the Canvas, safety cultures. That was great innovation at the time. The next phase is in crypto, blockchain, Web3, and I'm not a maxi to say that, but like that is where the last 5 Australian unicorns I can think of have come from. If accountants are closing their books to those kinds of clients, they're the ones losing out.
Yeah.
But also the 5 or 10 firms that actually do a lot of, I tell you what, their books are full. They're trying to scale as much as possible.
Yeah.
Especially when the bull market comes in, but a lot of them might be taking on new clients. So I send a lot of referrals out. I say, look, here's like the 5 or 10 firms. I like to spread it out a bit, because if I feed one too much, they're going to get full. And yeah, it's unfortunate, but this is the climate that we're in. And if you don't have a crypto tax accountant, get one now, because I tell you what, in July this year, like they're going to be very busy. If you're knocking on the door, say, I need help with my report, mate, they don't care. They got 1,000 clients ahead of you. So get some good relationships now.
All right.
Yeah. Awesome. We're coming up to our...
Wait, I've got another question.
No, you don't.
Okay. Damn it, I was looking at it being like one more. All right.
Yeah. Maybe. We have some time. But I want to touch base on when we'll go back a bit earlier on when we were talking about the exchanges and us not actually having ownership of that anymore. It's sort of like a debt and IOU, much like a bank. How does it, because obviously taxation, if I send from one of my MetaMask wallets to another MetaMask wallet to say deploy a contract from my personal, or maybe go mint an NFT, and I don't want my wallet, my main wallet, touching those smart contracts in case of phishing scams and wallet drainers.
Yeah.
How does that work with the exchange actually owning the Bitcoin, but I'm transferring it to my exchange account, for instance? Because technically thinking, and I believe you may have done a post about this, but I've seen Harry, where I transfer from my MetaMask to an exchange. I've now transferred my crypto to somebody else, where if it was an exchange, normally it'd be clear as day's taxable event, how they want to do it. But on an exchange, how is there a definition of that, or is it still just a grey area?
It's not particularly grey, but the outcome is good regardless. So just to get a little bit technical, won't be too technical, it's called CGT event A1. CGT event A1 is by far the most common. It's when I dispose of an asset, could be any asset. If I dispose of my one Bitcoin to an exchange and I receive back a debt, an amount owed in AUD effectively, then the argument is there that that's disposal event. And it's kind of hard to not agree with that, based on the writing of the law now, because you've got a different asset. Token to token transaction, that's a CGT event, because I've disposed of one Bitcoin, I've got one Ether. But when I dispose of one Bitcoin by transferring it to an exchange, commercially, I don't feel like I'm disposing of it.
No,
I'm transferring it to another account that I hold. But what do you own when you've got one Bitcoin sitting on an exchange? And this is what I want everyone to be very clear on. You don't own one Bitcoin anymore. You have a debt of some sort. It is a different legal right. It is a legal right compared to the Bitcoin you had, which is different.
Okay, so if we were to do that in the reverse and say I finally took what things I have on exchanges off and put it in a MetaMask, that is then me. How would it be taxed then? Because then that's just a money debt where I didn't own anything, and then I'm purchasing it then and getting it, or where are we at?
Well, it's still like an asset that you hold on the exchange. So that debt, what did you buy that for? So if I put 10,000 in, buy one Bitcoin at the time, it goes up to 50,000, and then I transfer it to my wallet. My first asset is I have a right against the exchange that I paid $10,000 for. When I transferred it, the market value was $50,000. Arguably got a capital gain there of $40,000, which does two things. Number one, triggers CGT, realizes a gain or a loss. Yeah. But number two, it resets that 12-month discount timing. Which is, sorry, Maureen.
Hey, it's better to know.
Is it?
No, it is better to know.
Ignorance is bliss. Ask Nathan.
Frankly, nobody treats it like that because it's dumb.
Yeah.
But that is technically what the law wants you to do. I've wrote articles saying this is technically what the law says, but nobody's really looking at this problem. But there needs to be a change to the taxation law about it, because this doesn't apply to shares. Because if shares are in a chess account, if I change my broker from CommSec to Perla, the chess arrangement is that it's actually just held in my name. The broker doesn't hold it for me. I don't have an action against CommSec. It's chess that registers my ownership.
Yeah.
And when it transfers around, it's not the same thing. So there's no other asset where you can really do this, which is why this is the first time this is coming up.
Yeah. Awesome. So it's quite very boring, but I did want to.
I never have it long enough with Harry. I've got so many questions, but I'm also very angry.
And on that one, I'll get my last one in before Maureen comes.
It's fine. It's fine.
Maureen jumps in on another question.
It's fine.
This is more like a question. So say, I guess how it would work in that same instance, if I transfer a wallet that I own from one I own to another one I own, it's not taxable. What happens if I transfer tokens from a wallet I own, but to a multi-sig that has, say, my wife and 3 kids in there? Is there any ruling on there? Because technically I'm still part owner of that wallet, but I'm not full owner. What's your thoughts on that one, Harry, with transferring to a multi-sig?
And then I have another one.
With multiple parties.
Well, it's, first of all, who owns the wallet? It's not just the multi-sig stuff, because for instance, we have a multi-sig wallet at the firm here, and there's 3 signatories on it, 2 out of 3 done. But the company owns it, not the signatories. So let's just say it's your wallet with a multi-sig, authorization on it, then it's just transferring from right hand to your left hand, nothing's changed. But if I've transferred to a multi-sig, so you transferred to obviously that me and Maureen have the keys for the sign, and we treat it as we're in partnership, 3 of us in partnership, then you would have a 2/3 disposal, because how partnerships work is you own 1/3 of all the assets of the partnership. So you would have a 2/3 would be disposed and 1/3 would be maintained. Partnerships are not well understood for tax purposes, but that's generally how they work.
Okay.
So before you make a transfer, if it's going to be your wallet, but it's like your, like hot wallet with multi-sig signatories on it, which is what I do, frankly, then just make sure it's documented whose wallet that is. Is it yours? Are you sharing it? Because that's going to affect people's tax reports.
All right. Next question for me. So what about building on from your question? What if we have an exchange transferred to an exchange? So if I have my debt with, say, Binance, and I send my pretend nothing to Qcoin, which is also a debt, is that, are we still, because we're not changing asset classes, what?
The exchange pays all your tax, Maureen.
So it's exchange's fault, right?
So you've got a legal right against Binance.
Yeah.
And you swap it for a legal right against KuCoin.
Yeah.
Disposal event.
Oh, come on. Come on, Harry. Come on.
It's moved to the UAE. That's the answer.
Yep.
Oh.
Yep. Well, with that one, Harry,
I've got one more question. So, retrospect, and then he can go. To be honest, I've got 4 more, but I'll only ask. I've got 4 more. I'll only ask my. Oh no, I forgot it. No. So
I'm charging you for the one after this, though, just so you know.
Okay, this is my last one then. I don't have money. I've lost it all in crypto. So, damn, I think I forgot the question. So when these when the tax laws come in, and say we were all operating on this understanding, is it retrospective?
Yes.
Great. You can go. Yeah. That's fine.
So, well, it's like, when it's just the ATO publishing on their blog what they reckon, it's not really prospective or retrospective. It's first of all just kind of nonsense. But it's also not law. So it's like, well, you could treat it practically as being only prospective. You don't have to go back and fix everything. But for a layer deeper than that, and that's as deep as I'll go, is when you look at tax return, it's about your mentality at the time. So if I've done everything right that I think I have the true belief that it's correct, and you've taken reasonable care in doing so you followed some tax rules, got a professional, whatever it may be, then there is unlikely to be any penalties in the event of an audit and a review where they change your return. But and this is partially because the ATO stuff is not really binding, there's no obligation for you to go back and change your returns. That's probably good news, Maureen. I think.
I've got more, but I'm not going to ask.
Yeah. Well, thank you for that, Harry. I think Maureen's got a bit to take away today from this episode. And
made her very unhappy. I see. That's
very unhappy, Harry.
Not Harry.
I'm normally happy after talking to Harry, but today...
The ATO has, Maureen. But on that one, Harry, I think this year is going to be a good year for crypto. Obviously, Bitcoin halving. We also got the ETF approval, which I didn't get to touch base on a few of those questions. On that, that's the whole nother can of worms.
I've got so many questions.
Maybe next time.
Just have me on every week, guys, if you want. That's fine.
We did tell you that, Harry. We do need you every week. So if you could just pencil that in from now, that would be great.
And with that, Harry, this year I would say I'll be definitely coming to you to get my crypto taxes sorted. So save a spot for me. Just save that spot for me, mate. Don't get fully booked out. And I'll be following you on TikTok, man. I love your videos.
Tell everyone where they can find you, Harry, before you go.
It's hard not to find me, frankly.
Okay.
Find me on TikTok. You can find me on Twitter. You can find me on Instagram. You can find me on LinkedIn. You can even find me on Pinterest if you really wanted to.
Wow. Okay.
I've got a website, which is cadenalegal.com.au. If you've got an inquiry, send it through the website. More than happy to refer people on to accountants, and we're happy to assist if we can. We're getting pretty busy, so don't wait too long. We'll get too busy. It's kind of hard to avoid me.
Okay. Well, we've had so much fun. Thanks for the grilling and being such a good team player.
Well, thanks. Good to be here. Always is. Get me once a year. I can scare everybody at least. That's why.
Yeah, well, you did a great job. So, thanks, Harry.
Awesome. Thanks, Harry.
Thanks, Harry. Bye.
Thanks. See ya.
Thanks for tuning in. We'll see you next week. Same time, same place.
Subscribe.